So I'll start off initially by giving a brief introduction about what we do at Flat 6 Labs. And then I'll go into financial planning and funding for a startup. What are the things that a startup should really focus on as a founder? You should really prioritize in terms of your financial planning, the sources of funding, what kind of budget allocation strategies you should think of. And then we'll finish off by what kind of runway you should be looking at, and when, in terms of that runway, should you start thinking about different funding options. So what should you be thinking about when you're close to a 12-month runway, 6 months, 3 months? I'll explain a bit more about what that means. And I mentioned earlier that at any time, if you have any questions, please mention that in the Q&A. If you want to raise your hand, go ahead, please, and we'll make sure to answer your questions. If there's anything unclear as well, some of the terminology that we'll use in the presentation, if it's unclear, just let me know, and we'll clarify that. All right, so I'll start off by Flat 6 Labs. Flat 6 Labs is a MENA seed stage VC and accelerator manager. What we do is we invest in companies at the early stage. So at the very beginning, when you're still in the idea stage or developing the platform or product, that's when we usually come in. We'll come in with what's called a seed funding. So what we'll do is we'll acquire a percentage of the company, somewhere around 10%, and we will invest money in your company and help you grow. What we start with is an accelerator program, a 4-month program where we'll take you through product development, ideation, understanding the market, the competitive landscape, etc. And then at the end of that period, we'll take you through what is called the demo day. So during that time, you'll be working on the pitch deck that you will present, which is a presentation showing what you've developed so far, who your team is, what's your addressable market, and what are your plans for growth. Once you present that, what you plan to do or what you hope will happen is investors will be watching during this demo day, and those interested investors will contact you for follow-on funding. Once they contact you, you will negotiate with them the term sheet and the shareholders agreement to see, to reach a middle ground of how much they want to take from the company versus what are the opportunities that they will provide you. The obvious one is the funding that they will provide, and then there's also some kind of collaboration. So maybe they'll help you in terms of business development, network, accessing a new geography, a new market, etc. So that's what we do. This is how we help: the cash funding, the support, the legal and regulatory help. This is all of the offerings that Flat 6 Labs has for its startups. In Bahrain, we launched in 2018. We're open to startups from all over the world, and we've so far invested in 50 startups. Maybe some of them you'll recognize. These are our star startups. We have Rasid, an investment app that lets you invest in startups in the US, or sorry, in stocks in the US. Sept, a curated fashion app, which lets you, as you use the app, it understands the kind of fashion that you are more interested in, and will start showing you things that are designed specifically for you. Unipal, which I hope most of the students who are attending this call are aware of. It's a discount platform app for university students, where you will have access to restaurants, coffee shops, gyms, etc., at a discounted rate for university students. So they work on both ends with universities to make that happen, and with the vendors to make sure that they're getting the most value out of it. And Tamarran, which is a platform where you can book coaches, you can find different sports activities happening around you, and you can find different groups playing football, basketball, etc., and then join them. So this is a few sample or a small sample of the startups that we've supported. And what we do is we come in at, like I mentioned earlier, the early stage, and we'll work with the founder to make sure that they can grow and scale to a larger scale, whether that means addressing a new market. So some of these companies in front of you, they're currently working on entering UAE, Saudi. Some of them already have, like Rasid and Tamarran, they're already operating or getting the license and operating in Saudi and the UAE. And then it also means growing in whatever market they are already in, and getting follow-on funding, growing the team, adding new offerings to their platform. So that's where we come in. So now to the topic of today, financial planning. So as a startup, you'll want to think about financial planning from the very early stage. So that's what is referred to as a seed stage. At the seed stage, you're in the very early stages, you might just have an idea at this point. You're creating the team around you. You're thinking about what kind of problem or pain point you can address, and how you can differentiate yourself from whatever is already available in the market, and how you'll be able to grow. And then also you'll be thinking about what is your so-called moat. So what kind of different skills do you bring, or what kind of differentiation you bring, and it will make it difficult for new entrants to the market to really compete with you. So that could be simply you've figured out a way to address a problem that you've made it more convenient for people. So a platform, for example, that makes it more convenient to find a specific service, access a specific platform. So you found a way that an idea that can be turned into a business. So this is considered the seed stage. At the seed stage, you're probably thinking about, very early, you're thinking about friends and family in terms of investment. Maybe you're using your own savings to invest in the company. You just want to get something off the ground. You want to have what's called the MVP, the minimal viable product. So at that stage, you just want to have some proof of concept to ensure that you're ready to go to market, and you're ready to at least present to investors who will take you to the next level. So that will take you to the startup stage. At the startup stage, you've had your product, you've started to gain some traction. So you have a few users on the product. It's still not growing at a large scale, but you've showed that it's a product that solves a specific problem and addresses a specific pain point. So you're applying to, let's say, accelerators, small scale investors to take you to what is known as the early stage. Early stage is when you'll start getting attention from more of the institutional investors. So now you're looking at venture capital firms, maybe a few angel investors who can take you to the next level. At this point, you're growing, you have your customer base, you're probably bringing in some revenue, and you're growing the team as well. And then you'll want to go beyond that to the growth stage. At that stage, it's just a matter of you've proven your place in the market, you've proven that this app or service is something that is needed in the market, and it's just about gaining that traction, achieving that large scalability, and getting on more customers, more users, and growing to a place where you're comfortable, you've gained a sizable part of the market, and you're looking to innovate, add new services, etc. So one of the things you'll need to think about when you're doing financial planning as a startup is allocating your budget. So this is what a typical slide on a pitch deck will look like. It will be more detailed. The percentages will change depending on what you're providing, but you'll want to think about three main buckets in terms of budgets when you're working on a startup. What's your team budget? What's the budget for the product? And what's the budget for marketing? As a team, you always want to make sure you have a balanced team that provides you with the core um, experiences and skill sets that you'll need. So you'll need, generally speaking, what we look for at Flat Six Labs is what are the two core competencies that are fulfilled. So a business-minded person and then a tech person. So a tech person is someone who will start doing the coding and the programming of the tech-led startup. And then later on in the life cycle of the startup will be able to lead the tech team. So this is someone who has experience in coding, programming, someone who is comfortable leading the UI, UX, so the user interface, user experience, coding part of it. And then will later on be able to, let's say, evolve into the role of a CTO of the company. The next thing you'll want to focus on is the product itself. So in addition to having a tech person, you might need to outsource some parts of the tech. So you might, for example, have the technical person on the team work on the interface while you will outsource the back end to an agency or to someone who is just freelancing for you. So you'll need to make sure you have the budget allocated for that. And then the last main part is marketing. So we've seen this with a lot of startups. They'll have a good product, they'll have a good team, good business acumen, but at the end of the day, you'll need to get the word out. And with a lot of the tools available today through digital marketing, it makes it easier to specify who's your target audience and who you want to, be aware of the product that you have, how exactly to reach them, what exactly are the pain points they're currently having and how to address them, and then what are the things that they prioritize when they're looking to be onboarded on a product like that. So if we go back to some of the examples that we have, if we look at Rasid, so they're providing the ability to trade stocks in the US market. So some of the pain points you might think of when you're addressing that is you can currently do that. You can currently trade in stocks. You might do it through larger platforms such as interactive brokers. In that case, the onboarding process might be a bit inconvenient or longer. You'll need to wire money to their headquarters in the US. You won't have all of the options that you might have. You could use a local bank here. The commission rates might be a bit higher. So it's about thinking about these pain points and how app like Rasid can address them. And then it's about thinking about your demographic and your addressable market. So for something like Rasid, it might be people who are in universities, fresh graduates, and beyond that, who are first-time users of trade stock platforms, who want to try their luck at the stock market, and then later on they might go into more sophisticated platforms. So this is, in general terms, the kinds of buckets that you need to think of when you're thinking about allocating your budget. It's the team, the product, and marketing. And after you've thought about mainly what are your large allocations, you'll start thinking about the different options within these categories. So when you're thinking about a team, generally speaking, at Flat Six and with many other accelerators or venture capital firms, they'll want to see a team that provides the core skills needed. They don't want to see a large team that will eat up significant parts of the budget, but they also don't want to have a team that is lacking some of the skills needed. So one of the main phrases you'll hear is that solo founders tend to be a bit more riskier. So if you have just one solo founder, even though he might have the skills needed, so he might have the technical background, the business experience, etc., but it's very difficult to manage all of these things together. So you want to think about who will you have on board full-time, who will you utilize as a freelancer. Another thing when it comes to the team and your operations is how important is it to have an office space? Depending on where you operate, so in Bahrain, for example, in order to incorporate as a company and have your commercial registration, you'll need to have an office space. But then you'll think about what office makes sense for you. So is it simply just to have a space and run your operations there, but most of the work you're doing is virtual or online? Then you might not need to spend too much on that. If it's a place where, depending on the kind of work, if it's a collaborative work, it's a creative work, then you might need to make sure that the whole team is physically in the same space in order to execute on what needs to be done. Then you start thinking about larger office spaces and something that makes sense that will allow for that collaboration. And then other things include registration and legal. This will also be part of your expenses, web services. So where are you hosting your web? What kind of other web services you're using, from mail, web creation, web maintenance, digital marketing tools, etc. And that also spills into the marketing budget. So with time, one of the metrics that we like to focus on with our startups is the cost of acquisition. So the cost of acquisition is an important marketing metric that we'll look at to understand how much is the startup spending while they're acquiring new customers. Does it make sense? Is it reasonable? Is it also reasonable in terms of comparables in the market? So depending on the kind of platform, you want to make sure that you're somewhere in line with other startups in your field. So these are, generally speaking, the expenses that you need to manage, and you need to make sure that you're checking them every now and then, and they're not eating up too much of your budget, but at the same time that you're spending on the things that will then come back and create revenue for you. So it would be unreasonable to expect to spend very minimal or almost zero on marketing and then try to grow your business, especially in the early stage when you're trying to get the word out and you're trying to acquire new users. On the flip side of that, you'll want to think about what are your revenue models that you will utilize. And you'll probably want to experiment with a few at the beginning until you settle into what makes sense for you. And these are just a few. There are so many different revenue models, and there's so many different hybrid ways of mixing and matching these different revenue models. So one would be a subscription model. If you feel that your service is something that people will want to continue using, then you want to make sure that they are paying on a monthly basis. So for example, something like a music service, a gym service, something like that. It's not really a one-time use, it's more of regular and frequent. So you want to make sure that they're on a subscription model. If it's a large service, then you'd want to, maybe they'll be paying by individual service. So one of the examples that we had, Sept, it's a e-commerce platform. So unless I'm providing an exceptional service that can be found anywhere else, then I'll want to make sure that they're just paying every time they're using a service, and I don't want to charge them on a monthly basis. So whenever they log onto the application and they use the service, they'll make a purchase, then they're paying the commission fee. Otherwise, then they're scrolling, they're looking at different options, and that would be totally free. The third part on the right, commission percentage. Again, this usually applies to e-commerce services. If you're an aggregator of services, whether it's e-commerce, food delivery, anything like that, then usually what will make sense for you is to take a commission on that. And again, even with the commission, it's still open to experimenting and trying different ways. So what we usually encourage our startups is to have a certain benchmark for the commission percentage, depending on their competitors, but then also playing around with that and seeing if they increase it, does it heavily affect usage? If they decrease it a bit, are they missing out on revenue that they could make? The other two are flat fee and freemium models. Flat fee is straightforward. You're providing a service, it's a flat fee. We usually don't recommend this approach, and it fits in with the general view of you don't want to have a flat fee or a flat service or a flat kind of offering, because you'll have different segments, you'll have different types of users. So as much as possible, when you have a startup, you want to make sure that for me as a user, I'm getting the service that makes sense for me. So it makes sense for how often I'm using the platform, what I'm using it for, maybe my location, if you're addressing different markets. And you can think of so many other different categories that you want to address. So the more customizable your revenue model or your service is, the more me as a customer, I'll have a better experience using that platform. And then freemium models is for services that you can really segment. So you might have some options that are free, and then to get the full experience of the platform, then you'll subscribe by paying a fee and then moving on to the paid subscription. So now that we've talked a bit about what are your expenses and what are your different revenue models, you'll want to forecast that. And this is just an example with some dummy numbers to think about your historical results. So you might not have them that far back, but you'd want to see how much you're making, what are your cost of your goods sold, your different expense brackets, and then your net earnings. And the reason you want to track that, and here in this example, it's annual, you might want to track it on a monthly basis to make sure you're identifying specific trends, understanding when users are using your platform more, when are sales going up, when are sales going down, when are your expenses going up and down, to understand that there's specific trends, and then to be able to be more prepared for them as you move forward. The second thing you want to do once you are accumulating the historical results is you want to look at your forecast. So here what you want to do is you want to just make sure that you understand what kind of revenue you can expect moving forward, what kind of expenses you might accrue moving forward, and to be able to plan for it effectively. So one of the things you'll need to really utilize heavily here is the assumptions that you will build into your model. So you want to make sure you have clear assumptions. You want to make sure you have reasonable assumptions. So if you have a specific growth rate, you want to make sure that it makes sense. It's not too optimistic or pessimistic. If you currently have a small team, as you expand, as your operations grow, you'll naturally need to onboard more people on the team. So you need to build that into your expenses. And one of the reasons you'll need to build this kind of model is firstly for you to understand what kind of expenses and revenues you can expect later on. But then also for investors, as they come in, they'll want to see what kind of projections you have moving forward. Is this a startup that is expected to grow at a large rate? Is it something that will be growing somewhat steadily until you hit a specific milestone, such as getting a license to operate in another country? So it will just give them more clarity and more understanding, and it will also manage their expectations in terms of what to expect from the startup in the future. So this is something you need to do for yourself and for potential investors. And then another concept that you'll need to be aware of and manage carefully, and this is one of the things that we work closely with our startups to make sure that they're aware of, is what we call the financial runway. So the financial runway is a concept of looking at how much money do you have right now and how much revenue you're bringing in, and what does that give you in terms of how much leeway or how much more can you operate. So with your cash right now and with your revenue, can you operate for 12 more months, 6, 1 to 3 months, etc. And these are the three main milestones that you want to focus on. Usually when you're operating and you just got a new investment, so let's say Flat Six Labs invested in you, or any other accelerator or VC, you want to make sure that the new investment gives you at least 12 to 18 months of runway. Because what you want to do when you get a new investment, which by the way will take a lot of time and effort from you to follow up with an investor, give them all the due diligence material that they will need, is that once you complete that, you don't want to think about funding or seeking investment for at least 12 to 18 months. You want to focus on operations, you want to grow, you want to address the user needs, etc. So if investment gives you less than 12 to 18 months of runway, then it just means that you're going to need to allocate your time again to investment and fundraising sooner than you would have liked. Around the 6 months mark is when you will start need to think about follow-on rounds of investment. So let's say from today, you secured your investment, it's giving you 12 months. So 6 months into that, you'll need to think about talking to investors, arranging calls, start working on your pitch deck and updating it, sending it to investors, accelerators, grants, etc., to make sure that once you're closer to that 1 to 3 months, then you've already secured that. Because fundraising will typically take time. It will typically need a number of calls, meetings, etc., with the investors to clear due diligence. And even once a decision is made that the investor is comfortable investing in your startup, then there's still negotiations in terms of how much equity are you giving up, what are they investing in, what are the different clauses that they will put in the agreements with you. At around the 1 to 3 months, so this means that your cash will only give you up to 1 to 3 months of your expenses, then you'll need to think about some alternatives. Will you sell your business? Will you, partner, merge with another similar business in the sector? You'll need to start thinking about, basically your plan B. What will you do now if you weren't able to secure funds? So this is the concept of the financial runway. Basically, you're thinking about with the cash you have right now and with the expenses you have right now, how much will this take you forward? And speaking of taking you forward or fundraising, these are generally speaking the typical ways of fundraising. So usually at the beginning, you're starting off small, you'll talk to friends and family, you'll invest some of your own money into the idea. Later on, as you grow, you look at accelerators, you look at what they provide, how much cash they provide, how much runway that will give you. Angel investors, you look at these groups, and you look at how they will be able to help you. One aspect of angel investors is that generally speaking, they'll be able to help you in ways in addition to the capital that they will give you. So they will connect you with potential business development partners. They'll be able to, maybe provide you with mentoring. So it's a bit more than just the cash that they will give you. Another option is grants. So you look at, government grants, for example, corporate grants. These will tend to be from players who look at different parts of the startup. So they want to support maybe a startup with a specific social impact. They want to support female founders. They want to support startups that operate in a specific sector that needs more attention. So these grants tend to be equity free. They'll help you, give you more runway. They'll give you cash that you can utilize in your expenses. And at the same time, you're not giving up a percentage of your company. And then the last category, which is one of the most active categories, is venture capital firms. So a venture capital is a company this is their bread and butter. This is what they do. They invest in startups. They will help take you forward. They will help connect you with startups in their portfolio, and they will negotiate with you a percentage of the company that they will take. So with that being said, I just keeping mindful of the time, I want to keep enough time for the questions and answers. What we've covered so far is usually what you look at in terms of financial planning and funding from the very early stage, from when you're thinking about an idea and thinking about how to fund it, how to get started, all the way until you're at a growth stage, looking at more institutional investors, looking at venture capital firms. And then also throughout that journey, you're thinking about what are the different budget allocation segments that you will want to prioritize, what are the different revenue models. And I'll leave you with the final thought of a lot of these things in terms of expense categories, revenue models, it's very dynamic. So these will change with time. If you start off with a specific expense structure, this is something that it's important to be aware that this will change with time. You can, as your team grows, maybe you'll have more budget as a team. Your revenue models will change as well as you understand your users. So that's it from me.